Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Nadek. You've probably heard the expression, a picture is worth 1,000 words. And in many ways, that's true. A casual flip through an old photo album will bring up a flood of memories. Where you've been, who you are with, and even clues to where you might be headed next. They're on full display. Well, you can think of a company's financial statements as a corporate photo album of sorts. They can tell investors a lot about a company's past, present, and future, if you know where to look, that is. Now, there's no question interpreting financial statements can be intimidating, especially at first. So, we're going to get some help from an investor who's been reading the tea leaves for over 25 years. Joining us is Peter Hodson. He's the founder and head of research at 5i Research. Peter, it's great to have you back here on the show.
Thanks, Jason. It's always a good time.
You got it. Now, why do you think financial statements can be so intimidating, especially to new investors?
Well, if you look at the average financial statement, there's three basic statements that you receive, but then there's usually 20, 30, 40 pages of notes that follow, and the notes explain everything that's going on. And so people look at this and it's like, if you need 45 pages of notes to explain the 3 pages of financial statements, then me as a novice or someone looking at it as a novice would say, okay, there's too much going on. And of course, you hear all sorts of things about how companies can play around with the numbers. They can manipulate their earnings. There's different interpretations of generally accepted accounting principles and things like that. So, I can see why people get intimidated, but at the same time, they're the most important thing you can look at when you're investigating a possible investment. But I think it can be overcome. I mean, it's a lesson in just diligence. You have to read these things, and the more you read, the more you'll understand, and the more notes you read, the more you'll understand what's happening. So it can absolutely be intimidating and frustrating, but at the end of the day, this is your money that you're about to deploy onto a stock, and if you don't read it and you lose money, then you can't really blame anybody else but yourself for that.
Yeah, you're the ones with the hands on the wheel, right? And I'm excited for our conversation. It's one of those things. There's so much information that's out there, like you said, that it's easy to glaze over or miss the forest from the trees, right? So yeah, really looking forward to our conversation. All right, before we do get into that, just a quick note to the viewers. We're discussing Peter's personal approach to interpreting a company's financial statement based on his own experience and style. However, there are many different ways an investor could choose to analyze financial data. So take this as a bit of a food for thought exercise into your own research process. Also, what we're going to be covering here today is really going to be a crash course on reading financial statements. Consider joining one of our other master classes on fundamental analysis if you'd like to learn more. All right, so Peter, you ready to dive in?
Ready to go.
Let's go. All right, so first question here. Where does analyzing financial statements fall within your investment research approach?
It's absolutely, at the top of the list. And over my career, when I was a portfolio manager, it became far more important than actually meeting the managers of companies. I've been in lots of meetings with executives of companies that have outright lied to me or my team. And, after a few years, you get kind of cynical. It's like, okay, are you giving me a true financial picture, or are you giving me a sales pitch? But you know what? The numbers don't lie. And they can be massaged, but at the end of the day, you can find out why they're being massaged or what exactly is going on. So it's kind of the be all and end all. It's the final result of what the company is doing. Numbers will be the driver of your investment at the end of the day. Everything else is kind of noise, but at the end of the day, it's if the company's doing well, you're going to do well, and if the company's doing poorly, your stock's not going to do well.
All right. So, in your opinion, what sort of knowledge and skills might an investor need when they're looking to evaluate a company's financial statements?
Yeah, and I think this is where people do get intimidated. They think, oh, I need an accounting degree, or I need to go to 4 years of school to figure out what's going to happen. And you really don't. It's relatively straightforward, and it's always repeatable. I mean, there are accounting standards, and this kind of makes it easier because every company has to follow those accounting standards. And so everything is sort of cookie cutter in terms of what they have to display. So the financial statements are all laid out in a certain way. The cash flow statements are laid out in a certain way. And so it's really just a matter of diligently reading as many as you can, and you'll pick up lots of good information just by reading. So I would say reading 10 financial statements of 10 different companies will do you far more use. It'll be far more useful to you than going to a university course on accounting for a year and a half. Now, it's important. You will need a basic understanding of accounting. You need to know what a debit is and a credit and what a payable is and things like that. But again, that's not that difficult. And there's some great websites that will explain all these terms as well as if you don't need them, if you don't know them.
And we'll get to that repeatable nature, that maybe like a checklist of sorts of things to look for in just a minute. But is it just as easy as comparing one company's financial statement to the other, maybe one of its competitors or another one on your watch list?
Yes and no. So this is where it gets a little bit more subjective. And so, it's almost useless to compare a company in a cyclical industry like a mining company to a software company. I mean, those comparables won't tell you anything at all because they'll have different margins, different growth rates, different everything. But absolutely, if you're looking at two investments in the same sector, one of those companies is going to be a better performer than the other in terms of the financial numbers. And typically, that company will have a higher valuation because it's doing better and it's displayed in the numbers. And then your job, of course, is to look at the numbers and determine whether that higher valuation is justified or not.
So you need to find more of like an apples to apples comparison to really kind of really get that information to stick.
Absolutely. Yeah.
All right, great. So let's jump into financial statements themselves. What sort of useful information do they contain for investors?
So from a high level point of view, they will tell you what their sales are, how much money they're making on their sales. So they've got your revenue, you've got your cost of sales. They'll tell you how much they're paying executives in terms of compensation, in terms of stock, which is important. They'll tell you their sales and administration costs, which are important. They'll tell you how the company's been financed, whether it's been selling equity or raising money through the debt market. They'll tell you the risk in terms of how much debt they have and versus how much equity they have. They'll give you a total picture of the bank statement, how much money is going in, how much money is going out on a regular basis, whether their inventories are too high or too low, whether they're paying off their payables, whether their customers are paying them on time. There's a ton of information that you can get on actually how the business is performing. One thing that's often overlooked is how much money they're spending for the future. So for example, they'll tell you if they're investing in new products, new development, research. It'll tell you whether they're buying companies or investing in factories, whether they're selling assets. A company, for example, might have great earnings, but maybe their great earnings came because they sold a bunch of assets and now they're not going to grow as fast in the future. Again, it's reading exactly the numbers, reading between the lines from what the company's presenting to what is actually going on.
All right, so we talked about what's in a financial statement. Can you maybe inform the audience what they can't explain?
The financial statements are a historical snapshot of what's happened. So it'll tell you exactly what the company looked like on one particular day. That'll tell you what happened that year, what happened that quarter, but it won't tell you what's going to happen in the future, obviously. And typically, it'll tell you what happened in the prior year. So if they're looking at 2023, then it'll tell you what happened in 2022. But it won't tell you what happened during the financial crisis or during the last recession or 10 years ago or 20 years ago. Again, all that information is available, but it's just harder to find because it's not displayed in a simple, one year comparison. Won't tell you how their competitors are doing. And that's where we like to go and look at other statements as well to see how the competition is doing as well. It won't necessarily tell you whether the company has met its goals. You may look at a company and say, oh, sales went up 10%, but you have to read either the management discussion or the annual report or some conference call transcripts to find out, well, maybe they expected to grow at 30%. So 10% is not so good in terms of what they were expecting. So there are limitations, but if you look at them over a multi-year period and you look at them repeatedly and you look at them compared to others in the sector, then you could get some good information.
All right, well, let's take a little bit of a closer look at the different types of financial statements. First one that we're going to look at here is the income statement. What's found in this one?
So basically, this tells you how much money or lack thereof a company is making from its main business, its operating business. So it's what your sales are, how much those sales cost. Do you have any other revenue? Do you have any other expenses? How much are you paying in terms of interest? How much you're paying in stock-based compensation? Are you paying down your receivables? Are you everything basically kind of the in and out of the regular main operating business. So we look at things like sales growth year over year, quarter over quarter. We look at gross margins, which is the sales growth minus how much those things cost you to produce. We look at research and development costs, and we find that very, very important, is how much are you spending on new products. So for example, if a company is spending $10 billion a year on research and another company is spending $1 billion a year on research, then maybe the first company is going to have more cool things in the future that they can sell to their customers. And the second company might have much, much higher earnings, but maybe the first company is a better investment because of that future potential that they're spending. So it'll tell you basically, are you making any money from your business is sort of the plain and simple, bottom line to the income statement.
Okay, the next one up is the balance sheet. What does this one detail?
So this tells you the financial strength or lack thereof of a company. So it'll tell you what they own in terms of what's in their bank account, if they have any marketable securities, investments. It'll tell you how much they own in property, plant, and equipment. So for a manufacturing company, that would be the actual factories that they own minus the depreciation costs on those. It'll throw in everything like every little thing like computers and software packages, like it's all rolled into what the company actually owns. And then another important part of that is whether they've got any goodwill. And that goodwill is when you buy a company and you pay more for it than what the books tell you it's worth. It's considered an asset, but you have to be very careful there, because if the company's paid too much for that acquisition, then it's not really that great of an asset. Then you have intangible assets, and that can be very, very confusing. But the best example of that is, say you're a famous soft drink company and you have a secret formula. That's clearly worth something, and that would be carried on the books at billions of dollars. But could you sell it? You're not really too sure you could sell it and whether you'd want to, but it is an asset, absolutely. So you have to be a little bit careful there, because intangibles and goodwill can sort of skew the numbers a little bit, and it might make it look like a company's got huge, huge assets, but you have to be careful to make sure that those assets are actually worth something. Then on the other side of the balance sheet, you've got basically how did you pay for those assets? Did you issue stock? Did you issue debt? Did you use prior earnings to pay for everything? How much stock are you issuing, et cetera, et cetera, et cetera. So they have to match. The assets have to equal the liabilities and the shareholders' equity.
Goodwill is an interesting concept for businesses to put into play. I don't think the bank would allow me to use goodwill on my next mortgage application, unfortunately. But yeah, maybe I'll give it a try. So, all right, the last one here, last statement, certainly not least, is going to be the cash flow statement. What does this one cover?
Yeah, so actually for us at 5i Research, we look at the cash flow statement first. And that basically gives you a picture of the cash that's going in the business and the cash that's going out of the business. And so we find that far more important than almost anything else, because everything else has got accounting standards and strange things that can happen one way or the other, or you can have aggressive accounting. So it consists of operating cash flow, financing cash flow, and investment cash flow. So operating cash flow is pretty easy. How much cash is the actual business generating? So again, it's your net income, and then you've got some non-cash expenses like depreciation, which are added back because you're not actually spending any cash on just depreciation. It's just an accounting standard. And then you have investing, which is, okay, how much did you buy of new stuff this year? How much did you sell in assets this year? And then financing, it's like, did you raise any debt? Did you sell any new debt? Did you buy back any debt? Did you issue any new stock? Did you buy back any stock? Did you issue any dividends? Did you get any dividends? Things like that. So cash flow is actually what you need if you're going to pay dividends, or if you're going to buy a business, or if you're going to buy back stock. You don't do it with earnings, you do it with cash. Obviously, at the end of the day, you want to have more cash, but there's more to it than that. If you've invested tons of money, your cash flow might actually be way down. If you've bought back a lot of stock, your cash flow might actually be way down. But those are not necessarily bad things. Some of them could be very, very good things, but it'll tell you exactly where the cash went.
All right, so you've already kind of started to allude to another one of things that you stress. That's the importance of notes on each of the financial statements. Can you maybe speak a little bit more about some of those fine prints and why it's crucial that you're aware of that?
A lot of people gloss over the notes, and I almost think you should read them first, because you'll understand the statements better when you look at the statements after reading the notes. So in the notes, they'll tell you all the fine print of what's going on. So, for example, if a company has a lot of debt, it'll tell you the notes will tell you the maturity schedule of that debt. And think about that from a personal point of view. If you've got $1 million in debt and it's spread out evenly over the next 20 years, that's not so bad. But if you've got $1 million in debt and it's due tomorrow, you got a problem. And so it's the same thing with companies. They'll tell you the debt schedule. The notes will tell you whether there's a thing called capitalizing expenses, whereas you spend money on something and you put it in an asset instead of expending it all at once because it might have a 10-year use out of it. It'll tell you whether companies do that. And research and development expenses is one thing there as well. So if a company spends $1 million, say developing a new software program, you can either write that off in 1 year or you can write that off in 10 years. And obviously that's going to impact your earnings. And the notes will tell you that of how that accounting is being displayed in the financial statements. If there's any bad debts, they'll tell you, what happened and what their terms are. So does a company write off bad debts when a company doesn't pay after 30 days or 60 days or a year? And obviously it's one, if you give your customers lots of leeway, that can impact your earnings because you're not writing off those bad debts. But a company that writes off their bad debts after 60 days, that's a little bit more conservative and you can be more reliable. You can count on those numbers a little bit more because there's not going to be a big charge because some customer didn't pay you for more than a year. There's a lot of variability in some of the treatment they do for accounting, and the notes will tell you essentially it boils down to whether your company is being conservative or aggressive in some of their policies. And obviously you want the more conservative company. You want the company that writes off everything right away, and charges everything to earnings right away. So there's no hidden surprises. But unfortunately, those companies are few and far between. So that's why the notes become more important.
All right, gives us some good context, like you're referring to. That's good to hear. Okay, now we understand what each financial statement has to offer. Let's walk through an example for each one. Let's begin with the income statement. What are we looking for here?
So the first thing, absolutely, at the top line is your sales or your revenue, basically. So how much money did the company bring in through sales, whether it was product sales or service sales? So absolutely the first thing to look at. Second point is your gross margins. How much did those sales cost you and what's left at the end of the day after sort of the basic expenses? Then you have net margins. What is left after everything? How much money did you make on those sales? And were you profitable or actually did you lose money, which happens in quite a lot of companies. And then you sort of break down beyond that what's the reasoning behind the numbers you've just discovered. So for example, if your profit margins are down, why is that? Did you pay more in interest expenses? That'll be listed. Did your selling and general costs go up? That'll be listed. Did your research expenses go up? And that'll be listed. So sort of a bullet point. And you don't necessarily want to look at these in isolation. You want to look at how they've trended as well versus the prior year. And even if you can go back to other financial statements as well and go back more years and just see how they've trended. So what you want to see is you want to make more money at the end of the day on incremental sales. And that gets right down to your net margin line. Is how much money did you make from an extra dollar in sales? And you want that margin to go up because you want that earnings leverage to improve year after year. You want to make more money on every dollar, basically, because if you're making less money on every dollar, then your next dollar in sales doesn't really help you because you're making less money than you did on the prior dollar. So you break down these points and it's like, okay, how much did you bring in? How much did that cost you? And how much did you end up with at the end of the day? Tax is also another line you have to look at. And especially looking at smaller companies. A lot of small companies get tax incentives, tax breaks, or they have losses from prior years that they can carry through. And they don't actually have to pay a whole lot of actual tax on their earnings. Again, but if you're looking at that company for a 10-year period, one day they're going to have to pay tax, and you want to try and normalize that situation, and that the income statement will tell you exactly what's going on there as well in terms of your tax obligations.
All right, so let's get hands-on with an example company. What stands out to you here in the income statement?
We're growth managers, and we have a company here that's actually had lower sales than the prior quarter. It's like, okay, so what we'd really want to investigate what was going on there in terms of why did sales go down for this particular company? What happened with the profit margins? It's like they actually made a pretty good profit margin considering that their sales went down. So they didn't do very badly at all compared to prior years. It's like, okay, well, how do we break that down? And then we look at the breakup of sales. You've got product sales and service revenue. And typically, service revenue is far more profitable than product sales. Here, this company has increased their service revenue quite substantially, and it's higher margin revenue. And lo and behold, their profits are doing okay considering that their sales went down. So we like to see that. We also see that research and development costs went up. So even though sales went down, this company continues to spend a lot of money on research to try and develop whatever it is they're going to come up with next. And so that's pretty good to see as well. And so if you go down to the per share earnings actually went up even though sales went down. And we can tie that back into what's happening with the balance sheet and the cash flow statement.
All right, well, let's take that opportunity to move on to that balance sheet. What details here are you focusing on?
For the balance sheet, really on the asset side of things, it's really the relativeness of the items in the balance sheet. So for example, inventories. We don't want to see inventories go up at a much faster rate than sales. And so if inventories are going way up, you might have a problem because that means maybe they have to be written down in the future. The best example of something like that is a fashion retailer. If you're a fashion retailer and you've got $100 million in inventory and the fashions change, then suddenly all that inventory is going to have to be marked down because you've missed that fashion cycle. So inventories are very, very important. We like to look at cash. How much actual cash do you have on the books? One of the things that we like to do is we like to eliminate future problems. And really investing is about eliminating the lousy companies, and so you can concentrate on the good companies. And so a company that doesn't have a lot of cash in terms of flexibility can be potentially more risky than a company that has a lot of debt. So obviously that takes us back down to the debt line. If you've raised a lot of money in terms of debt, now you've got a company that maybe that's a future problem. If your debt keeps increasing year after year after year, I want to look at declining debt or even no debt, which is ideal for us anyway, in terms of eliminating future problems. You want to look at goodwill. Goodwill's an interesting concept, but it's also a potential problem. If a company is not making as much money as they thought from an acquisition, then that could be a giant future write-down of goodwill in the future. And some of these numbers can be very, very big. If a company buys a $2 billion company and suddenly it's not worth, it's not generating income, you could have a $2 billion write-down. They could write down that thing to zero and your losses can go up astronomically. So that's one thing to look at for sure. The equity component's not quite as risky because this is the amount of money that you as the owner of the company has in the company. There's a couple of ways you can play around with this. A company could pay out more dividends and so your actual equity could go down, or they could buy back stock and your equity could go down because they're spending money to buy back stock. So both of those are great, but they can sort of be a little bit confusing on the balance sheet because you've got a declining trend and you have to figure out what happened. Why did equity go down? Oh, it's because I got a giant special dividend. That's much different than something else where you had a big write-off and your equity went down. You want to look at trends and you want to look at how these balance sheet items compare to what's happening with the business in terms of sales as well. So anything that's an aberration has to be looked at a little bit more closely. So if receivables change much faster than sales, then you have to find out why. Same thing with pretty much almost every line item. You want to compare that to the growth rate of the company. And if there's something off, if something's changed by twice as much as sales, you need to find out what's going on that particular item.
So, what clues does our example company's balance sheet give you about its financial health?
So here we've got a company with a lot of cash and a lot of marketable securities. They've got current and non-current securities. So non-current are securities that mature in more than 1 year, and current are within 1 year. We haven't gone to the debt situation yet, but right now, looking at just the top part of the balance sheet, here's a company that's just absolutely rolling in cash and securities. So that's not too bad, as we'll see later with the liabilities. We've also got a situation where inventories have gone up a little bit, but nothing dramatic. It's something to watch though, because if your sales have gone down and your inventories are going up, then you do have to be a little bit careful with that trend, because a lot of inventories can mean write-offs down the road. But that's not a problem at all here, at least so far. But it's something you have to watch. We've got a company where both the accounts payable and accounts receivables have gone down. So the receivables are the money that your customers owe you. So they've gone down, which means your customers are paying you on time, which is great. The payables have also gone down, which means you're paying your bills at a faster rate, which is fine. I mean, it's not necessarily good or bad, but you don't want either of those to skew dramatically one way or the other. If your receivables go way up, then your customers may not be paying you. And if your payables go way up, then maybe you're having problem paying your suppliers. You have to watch the trends versus sales, but neither one is a particular problem for this particular company. Then we've got assets. It's like I don't see any goodwill on this balance sheet, and I don't see a lot of fixed assets. Companies not out there buying factories. They're not buying companies at higher valuations than the accounting, so they don't have any goodwill. Just a pretty good, solid company there.
Okay, so we've checked two boxes. We've dug into the balance sheet and the income statement. Now let's take a look at the cash flow statement. What information are we looking for here?
That operating cash flow line is absolutely key. It's like, how much are you generating? And then next is how much, what are you doing with that cash? We would like to see high dividends or high stock buybacks. Basically, if you've got too much cash, we like you, but now what are you going to do for me? Are you going to give me that cash? Are you going to buy back stock, or are you going to make acquisitions? And again, it's not necessarily, I don't want to argue one's better than the other, but you need to know where that cash is going. How much of that cash flow is going to pay down debt? How much of that cash flow is going to me, the shareholder, in terms of dividends or buybacks? How much of that cash flow is going to invest in the future? You want to know, what percentage of cash flow did cash flow change by a greater percentage than sales? Again, a lot of it, it's all tied together. Is how has cash flow changed in relation to the rest of your business? And we would like to see growing cash flow, obviously, again, to eliminate those future problems.
All right, let's circle back to our example company. What does its cash flow statement say to you?
You've got a company that's generating lots of cash, and they're buying back a ton of stock. 56 billion in common stock they've bought back over the past period. And if I can tie back this into their earnings statement, their income per share actually went up, even though sales went down. And now we know why. And that's because they have fewer shares outstanding than they did last year, because they spent so much money buying back stock. Other thing in the example company is they haven't really spent a lot of money on stuff, for lack of a better phrase. Their property, plant, and equipment hasn't changed a whole lot. They're not out there buying new companies. They're not out there expanding. It's a relatively small amount of money that they're spending on such things. So sometimes for other companies that can be quite dramatic, but in this situation, they're not doing that. They're just making money from the regular business. They paid shareholders $11 billion in dividends, and that's versus $88 billion in operating cash flow. So there's a $77 billion cushion there on your dividends. So what tells you your dividends probably not at a lot of risk here, because there's such a big cushion. So yeah, it's a company that's in pretty good financial shape, generating a ton of cash, and they've decided to return that cash to shareholders with dividends and buybacks.
All right, thanks for walking us through how you analyze a company's financial statements, Peter. I'm sure this crash course has given our viewers a lot to ponder. And on that note, let's hop into WebBroker to show our viewers how to find the financial statements to get their research started on their own. Now that we've begun to learn about fundamental analysis, let's take a look at some of the tools that WebBroker has to offer to help you with your analysis. Now, we're on the stocks overview page, looking at a sample company. Beneath the quote, you'll notice there's a series of tabs. We're going to be choosing the fundamentals tab, which is the fourth from the left. On this page is where we're going to have access to many of the important ratios, as well as all of the statements that we've learned about in our discussion with Peter. Below the fundamental tabs, there's 3 sub-tabs that we're going to explore in greater depth here. We're going to finish off the statements, don't you worry. First, I want to point out the industry comparison. This is where you have the opportunity to compare the sample company with how industry averages are across that particular sector. You're going to be looking at many of the important ratios, your price to book, your margins, return on equity, your dividend rates. All of that is here. You can see how the company compares to the industry that it relates to. If you'd like to go one level deeper, there is a peer comparison tab that's going to be available for you at the top of the page. Not only are we comparing to the industry average this time, but we're also comparing the company from a fundamental information perspective across its closest competitors. So we can see that there's 4 other competitor companies that are here, so we can make sure we're doing our due diligence to make sure that our investments are going to be the ones that meet our needs most specifically. All right, and then last but not least, we've talked about this with Peter. Let's dive in and take a look at the financial statements. On this particular page, we've got our income statement, we have our balance sheet, as well as the cash flow statement. And what's really important here is we're going to get a look back, so we have the opportunity to see the 5 most recent previous years to do some comparison and trend analysis of the fundamental information we're looking to gather. First of all, on our income statement, if we go down here, this is where we have our opportunity to review the company's revenues, its operating incomes, as well as its net income. So much is available here. Lots to really soak in. Now, moving back to the top, we've got our balance sheet. On our balance sheet, we have the opportunity to see assets versus liabilities of the company, once again over the preceding 5-year time period, to really get a good sense of the longer term trend in these data points. And then last but certainly not least, we've got our cash flow statements to see our total cash, the operations of the company and how it's spending that money. If we go down and look a little deeper, we can see the investing the company is making. As well, we have the opportunity to see any borrowing or financing the company is taking on. So really a broad spectrum of data points for us to really, once again, be informed of what's going on. And just a quick reminder to our audience, Peter talks more about some of these factors he looks into for researching companies in his last webinar with us. It's called 5 Ways I Find Value in a Down Market, and it's available in the Learning Center on Webbroker and on TD's YouTube channel. All right, we're going to have to leave it there, Peter. Any final thoughts you'd like to share with our viewers?
We talked about intimidation at the startup, and I really, it's not that, I don't want to say it's not that difficult, but it's certainly not insurmountable. You can look at these things, and maybe the first statement you read, you're not going to understand completely. But the second one, you might pick up a few things. And by the 10th one, it'll start becoming a little bit more common. And I really do think it's important. And most investors don't like to lose money. And it's the best way to sort of reduce your risk. And, nothing's risk-free. But if you can reduce your risk and sort of skew the odds into your favor a little bit, then you should be a much better investor. And I think that all comes back down to the statements.
Well, this is the second time you and I have had to have a conversation in this setting, and you did it again. I myself have learned a lot, and I know our viewers will as well. So thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We'll see you all next time.